Welcome back to Lamb's Cryptoverse. Wow, today's July 13th. It's a Wednesday, but it feels like Friday the 13th. The Bureau of Labor and Statistics gave us a doozy. The CPI, which you can read yourself because our job is to interpret information for you, not to read it to you. But today, as a headline, today's CPI for June was up 9.1% year over year, and that's above the 8.8% expected, which was already increased a few times. So this is just bad. It was bad, bad, bad. No other way to put it. We're at a November 81 high, so we're over a 40-year high in CPI on a year-over-year basis. And most of this came from energy. About half of the increase came from increases in energy prices, and that's going to be coming down. Commodity prices over the last few weeks have just been tumbling, so that's going to help the CPI. But I got to be honest with you. The market was expected to go up in my view. I thought it has been risk on, so I thought if the CPI just comes in little below expectations or even at expectations, the market could just take off because it was ready. All the indicators I look at show that the market was oversold. But you know what? Sometimes things are just bad and you can't put lipstick on a pig. This is just a really bad number. And when something's this bad, the market has no choice but to decline. But there are some places where I see good asymmetric risk return no matter what happens, and that's the bond market, specifically long-term Treasury bonds. Because if you think about it, if CPI becomes in higher than expected, which is what we saw now, the investors are going to expect the Fed to raise rates even more aggressively, and that's what's happening. If you look at the CME Fed Watch tool, over 50% of investors now expect the Fed to raise rates 100 basis points on its next July 26th, 27th meeting. That's insane. So going back to this risk return, if the CPI is higher than expected, investors are going to expect to see the Fed raise rates more aggressively. And that's what we're seeing with the CME Fed Watch tool. But what if the CPI is not higher than expected? What could happen to rates? Well, I think long-term rates could decline anyway because rates overall across the curve would decline. So again, if the CPI comes in higher than expected in the future, or like what happened today, you're going to see a inversion in the yield curve and long-term rates will decline. If the next CPI, the next few CPI reports come in better than expected, so lower inflation, you're going to see a flat decline in the curve, across the curve, meaning rates will decline across each tranche of time, right? So the 5-year rate declines, the 10-year rate declines, 7-year rates decline. So I think a good place to be right now is in long-term treasuries because you have lower risk than you do the stock market. But if you are an aggressive trader, I still think now's a good time to put on those trades because we should have a short covering rally. As I said earlier, the market's oversold. So that's it. Good luck with your trades. We still have 2 more days of terror. And remember, this is not financial advice. I'm here to educate you. Thank you.